What is a mortgage contingency? My name is Will Hooks and I'm your local Las Vegas realtor. Today we're going to be continuing our series discussing the most common types of contingencies in residential real estate. The content is a little dull, but definitely some important terms to understand. I'll try to make it as painless as possible. Most real estate transactions come down to a buyer being able to acquire a mortgage. If a potential buyer signs a contract for a new home and then discovers they can't secure financing, that's when a mortgage contingency can come into play. Mortgage contingency can also be known as a financing contingency or a loan contingency. It's a clause that allows buyers to cancel the contract of a home purchase without penalty and receive a refund of their earnest money deposit if they're unable to secure a mortgage. Let's take a closer look at how adding a mortgage contingency clause to a home sale agreement can benefit both the buyer and seller. A mortgage contingency clause in real estate transactions gives home buyers a time frame to secure a mortgage loan for a home. If the loan can't be secured, the buyer can walk away without legal repercussions and have their earnest money deposit returned. The loan contingency period is typically contracted to last between 25 and 60 days and must be agreed upon by the buyer and seller in a purchase contract. The buyer is usually expected to secure financing and gain approval for a mortgage before closing on a house can begin. When a buyer is ready to buy a property, the first step is to submit a purchase offer to the seller. If they haven't been pre-approved for a mortgage or aren't sure whether they'll qualify for an appropriate loan, they can add a mortgage contingency to the offer. Once both parties sign the purchase agreement, the buyer will submit an earnest money deposit and the seller will take the property off the market. At that point, the buyer has the length of the mortgage contingency period to obtain financing from a lender. Once approved for the mortgage, they provide the seller with a mortgage commitment letter from their lender, and the next steps of home closing process are set into motion. If the buyer doesn't qualify for the loan or fails to secure financing in time, they can terminate the contract. With a mortgage contingency clause, either party can back out of the home sale agreement during the contingency period with no penalties. The seller will be free to pursue other offers and the buyer will receive the earnest money deposit back. What goes into a mortgage contingency clause? The home buyer and seller must agree upon the conditions outlined in the mortgage contingency. It includes details about the lending terms, the mortgage contingency deadline. The mortgage contingency period mandates how long the buyer has to secure the appropriate loan. And the deadline is typically set for between 25 and 60 days, and both parties must agree on the time frame. In some situations, the buyers and sellers may opt to add a mortgage contingency extension date in the purchase agreement. This lending term includes provisions for stretching the mortgage contingency period if the buyer is unable to obtain the appropriate loan before the deadline. However, the seller isn't obligated to grant a contingency extension, and they can walk away from the sale if the contingency expires. The types of mortgages. Most mortgage contingency clauses specify the type of mortgage the buyer needs to secure. After reviewing the loan options, both parties must settle on the specific mortgage loan the buyer will need to move forward in the closing process. The amount of money needed. One of the most important terms of the mortgage contingency clause is the exact loan amount the buyer must be approved for. This condition acts as a secondary protection for the buyer. If they're approved for a mortgage but not the amount listed in the contract, they can cancel the sale without consequences. Closing or origination fees. Before signing the purchase agreement, it's important to establish the closing costs and fees that the buyer will be obligated to pay to secure the loan. Among other fees, the mortgage lender typically charges origination fees, which include the cost of processing, underwriting, and funding the loan. It's helpful for the buyer to factor these additional fees into their home buying budget and be vulnerable to additional fees and potential lawsuits. Should you waive a mortgage contingency clause? Although the mortgage contingency clause is included in most real estate agreements, some buyers can and may choose to waive it depending on their circumstances. Buyers may consider this option if they're paying for the property in cash or they've been pre-approved for the necessary loan. In a competitive market, a seller who is weighing multiple offers may ask buyers to waive the mortgage contingency in order to close the sale quickly. Foregoing the mortgage contingency clause can be risky. If the buyer's mortgage application falls through, and after they waive the protection clause, the buyer will lose their earnest money deposit and be vulnerable to additional fees and potential lawsuits. The mortgage contingency clause is a commonly used safety net to protect home buyers and sellers from unexpected changes during the home buying process. Both parties should be prepared to discuss the lending terms during negotiations and understand the risks of waiving the clause entirely. This concludes the segment on mortgage contingencies. Stay tuned for a closer look to other common contingencies in residential real estate. I hope this has been helpful. Please like, comment, and subscribe. I'm Will Hooks. I'm with ERA Brokers Consolidated.